Hello friends, we are going through very uncertain times and with important events such as budget and monetary policy adds to volatility in fixed income. Please allow me to take you through the budget followed by our expectations on monetary policy scheduled later this week. Budget has attempted to give a thrust to growth without deviating from the path of fiscal prudence, with fiscal deficit pegged at 440 for FY26 and FY25 revised lower to 480 of GDP. Gross borrowing is pegged at 14.82 lakh crores and net at 11.54 lakh crores for FY26. Government has also planned a bond switch program of 2.5 lakh crore for FY26 and 1.5 lakh crore for FY25. This is marginally higher than overall market expectation. Overall, the assumptions are reasonable and shall be achieved easily. The budget is positive from sovereign rating point of view, but it's tough to take that call right now. Banking system is passing through very tight liquidity phase, with core liquidity turning negative from a surplus of 4 trillion over last few months. RBI has taken few measures to add durable liquidity and has announced 60,000 crore worth OMOs, out of which 20,000 crore has already been done, and has done market purchases of gilts worth around 30,000 crores, making total purchase of 50,000. FX swap has done of about $5 billion, which is 44,000 crores, and has also announced long-term repo for 50,000 crores for 6 months starting 7th of Feb. INR has depreciated to 87.1 mark. Given the pace of depreciation, this number is a bit concerning. However, given the general dollar strength versus all major currencies, it's prudent that INR also adjusts sooner than later. On the global front, the Fed has decided to stay on pause for this time, but broadly remain committed for cuts ahead if data supports. Trump administration has gone ahead with tariffs on Canada, Mexico, and China, which has added towards volatility in the global markets. However, 10-year USD remains around 4.5 for now. Friends, we have MPC scheduled on 7th of Feb. In light of budget and global dynamics, we expect the following. We expect RBI to revise current year GDP forecast to around 640 and peg the number at about 6.5 or above for FY26. RBI is expected to maintain the current year inflation, but revised next year inflation number to around 4.2. RBI is expected to cut rates by around 25 basis points in the coming policy and give an indication for more to come in the next policy. RBI expected to maintain the stance to neutral and may take measures to add durable liquidity such as OMOs or CRR cuts. We expect the yield curve to become steeper, especially between 5 to 10 year, which is flat right now. The longer end of the curve, the 10, 30 and 40 year is 40 basis points steep and is expected to remain under pressure given the demand supply dynamics. However, overall yield curve is expected to move in bull fashion. We recommend investors to remain constructive on actively managed duration funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.